Now, there are a couple of terms that you may run into or you may not, but just to be thorough, early market profile was data provided by the CBOT, and it was used in conjunction with the liquidity data bank of the CBOT. And the liquidity data bank recorded trade activity and classified it based on who was doing it. And I think this is right. You had the commercials, the funds, the public, and the floor. And it was thought that, you know, that you could read what the commercials were doing or what the funds were doing, and you could see if they were selling up here at this extreme, and you'll hear the term capping the market and things like this. Well, over time, because the trading world has blown up in terms of the number of people and institutions that trade, that all of these have sort of morphed into basically two groups of traders, the big money and us, the big money and everything else. And you'll hear me refer to the big money or not the big money. Who it is at this point in time can no longer be determined with any consistent accuracy in real time. Now, the other thing that you'll hear, and this is a legacy market profile concept, and this is tied into the idea of day type, the other time frame player. Now, when everything went through the trading floor, if you were on the floor, you could stand down there and you wanted price to stay in a range because you didn't have to pay the bid-ask spread. You could stand down there and make a market and you know, trade the bid-ask spread and make a fortune. And that was the easy way to make a fortune. There was no reason for the pit to drive the market outside of a given range. Everybody on the floor knew it, and that was the game. Now, everybody on the floor, you know, they would lose money when the market would begin to trade outside of a range. And the only reason that the market would trade outside of a range was if the other time frame player, in other words, somebody, you know, a hedger would come in. General Mills would come in and buy corn or somebody like that. They would come in and take a longer term position, and it would overwhelm the supply-demand equation in that time frame, and it would drive the market higher, would drive the market lower. Well, that's not the floor traders driving the market. There was no, they didn't need that. They really didn't want it. They didn't need the risk. It was the other time frame player. So, and this was the genesis of this day type thing. It was thought that if the market traded outside of a range, outside of a certain time frame, it wasn't the floor, it was big money moving in and taking a position, etc. So that's where the term time frame player came in, and that's also a little bit about this day type stuff. Now, we may or we may not go into the day type thing later. I'm not going to do that tonight. Do you guys have any questions so far? A lot of this is background information, but I've been talking a lot and not really paying attention to the chat. Or are you awake if I put you to sleep? I realize it's getting late. Okay, the concept quickly morphed into being promoted as something magical, and it was claimed that they could type days and predict what the market could do. It could not, and it cannot do this, and a lot of this stuff is still out there and being promoted. Now, there's some other market profile fallacies and misconceptions. I'm going to put together a glossary, and I will have this glossary available for all of you in the next session. I think it's important, and I'll define some of these things more completely then than I'm going to tonight. But, you know, this point of control thing is something I hear constantly. You know, you hear the point of control, a virgin point of control, a naked point of control, you know, all this stuff about point of control. Well, there's no single price that's magical. A point of control is, to a large degree, you know, a chronological coincidence of price activity. There's nothing magical about a point of control. We refer to a high volume node. It's an area where most of the trading occurs. There is significance to that. But the single price in that area, there's no single price that you can go back and consistently say, well, this was the longest TPO line in this, and it was, look how price did this or did that or whatever. You want to stick with the bigger picture of what the auction is doing and not try to impute magical properties to a graphing format. Day types were the early theme, very early theme of market profile, and it was an obsession of early market profile traders, and still to this day. Their day types are too nebulous to be of any use, except in general terms. There's some times where a day type can be helpful in nothing else as knowing what not to do and what's likely to happen based on some basic observations and statistics, and I'll share that stuff with you. But the important thing is about the day type thing and why it's not valid is that you cannot take a market that is dynamic and is in an ongoing process of development and divide it up and slice it into neat, comfortable, chronologically divided pieces just because that's when an exchange is open or closed. We have 24-hour trading now. Even, I don't know, 10 or 12 years ago, I didn't pay that much attention to Globex in the stock index futures. Well, I do now. I don't separate it out at all. It's just one market. There's enough volume now, and the markets are so correlated now that you better be paying attention to what's happening in Globex. You have to. It's not just what happened today. It's, today is continuing right now in front of me. The S&P's up a quarter of a tick. It's up one tick. And this gets back to the context thing. It gets back to the worldview that you're going to develop over the next 7 weeks. Now, this is one of the, it's really a foundation. It's a foundational market profile principle, and it's also one of the big fallacies of market profile trading. And it's important that you understand this because we do use this concept. Part of this concept is valid, but part of this concept is not valid. And the key is, and I want to emphasize this, don't try to turn this into a rote, paint-by-the-numbers approach. You want to understand the market. All of this stuff that I'm showing you should be used to understand what the market is doing through the lens of an auction market. I'm going to get more into the specifics of an auction market next week. And then you can, those of you that may be a little bit lost right now, then you can go back and you can revisit this because they fit together. But there's the market, one of the big profile fallacies, and to this day, this thing about the P and the B, and this was actually the foundation of Stottlemeyer's early work. And he had posited a 4-step process of development. And that process of development was inefficiency to efficiency in an endless loop. And this is where Stottlemeyer's means of communicating and so much of the semantics, the nomenclature of market profile is prototypical Stottlemeyer. It's a little bit fuzzy. You're not real sure what it means. And that's why I'm going to do a glossary. I'm going to do a glossary and put all this stuff together so that you know what we're talking about, but you'll also know what other people are saying, and you'll be very quickly be able to tell if they know what they're talking about. But when we're talking about inefficiency or efficiency in terms of the market and market development, inefficiency is when trade is one-sided. Today was an inefficient market. You can say that the stock market has been inefficient since December 30th. It's been straight up. It's not facilitating trade. It's a very one-sided market. The market is being overwhelmed by buyers. The buyers are in control. Efficiency is when trade is being fairly, in other words, it's fair to both parties, quote unquote fair. And fair being the judge of both parties, where both parties are comfortable trading. It's a price that's not too high or too low to the buyer or to the seller, or vice versa. When prices are unfair, it's sort of a forced situation where the shorts, like in the stock market, the shorts are getting run over, they're capitulating, margin calls, all of this type of thing. But the market will go higher until it runs out of buyers, and that's something else we'll cover at another point in time. But that's an important auction market axiom. When's the market going to stop going up? Well, when it runs out of buyers. And that's I mean, I say that flippantly, but it's important to understand that. This market is going to go up because there are buyers. There are buyers willing to buy it. Every time it goes higher, there's still some buyers. We're going to talk about the stock market at the end of this, by the way, again. Okay, the four-step process. Step one, you have a trend that stops the market. Or actually, you have a trend. Then you have a stop, and then you have development around that price, and then then the process starts over. This is not properly ordered. So here's your step one. The market trends, it goes up. Then step two, the market become more two-sided. In terms of bars, it's a consolidation. The bars begin to overlap. There's chop. That's trade facilitation. That's the normal state of a market. Then step three in Stottlemeyer's initial work was the market would become mature at this point, and then you would have the first standard deviation. This was a third standard deviation. All the volume was in the third standard deviation, and you would have that volume migrate so that over time this distribution would develop such that the bulk of the trading was near the mode of this structure, the statistical mode. So that, and to this day, you hear people, well, this is a P, this hasn't been filled in, so when this breaks, it's going to be down. Well, no, that's not what happens. All we need to know, all you need to know is this. When you see this, it's opportunity. It might turn into this, and that's fine. We'll trade it. Or it might not. It might go up, and that's fine, and we'll trade it too. But the migration of this structure is a big determinant on, well, it determines the trend of the market from our perspective, but it also determines your strategy and your trade tactics in all levels, all degrees of trading. This process occurs in all degrees of time, these three steps. You have a step one, a step two, the market becomes two-sided, and the process starts over again. Sometimes it's clearer than others, but it's always there. So this is what would happen. You would have step one, step two, and then this structure would mature, and then you would have the break up or down. And basically this and this are the same thing. They're just different time frames. But you do not always have now. Like for instance, in a perfect textbook Stottlemeyer world, we would be looking for the stock market to eventually develop back down to the December low and fill in this nice Gaussian looking shape between whatever high is formed in that low, and then it would move again. And here's the B. The B is the inverse of the P. But we use this in a specific way, and we use it differently than anybody else. Most other people use it. This process is a logical dynamic of an auction market, but it's a dynamic process. It's not a mechanical one. You cannot assume that just because a market trends and then it rotates for 3 or 4 hours at the top of the range that the break is going to be down. We all know, those of us in this room that have been, clients for a while, that doesn't happen. That doesn't always happen. Sometimes it breaks up again. Now, this is an example that some of you have seen before, and it's a market. This is the S&P, and here's a B, and here's a P. Now, under a perfect textbook world, we would know now that, here's your high, here's your low, and this is going to fill in a real nice, neat fashion. And all we have to do is sell here and then buy back down here and then buy here and sell up here. And, we just get rich the easy way. Well, yeah, the market breaks higher and it forms another P. The market breaks higher again, forms another P. And the bottom line is, this can go on and on and on, day after day, week after week, month after month. And so you cannot rote trade the idea that just because there is a lot of volume on a stick, up or down, that it's a P or a B, and there's some magical force that's going to create the pull of that market away from the volume down towards through the stem that that it's attached to. Sometimes it does, sometimes it doesn't. But you've got to be open-minded about which way it's going to go. And, the same thing for the B thing. So this is a legacy concept. It's not tradable. The three-step process, Troy will show you the three-step process all day, every day in various markets. And so will I. We talk about it. It forms a concept. It forms part of the answer of the question you're always asking. What is the present market condition? If I'm looking at the S&P, and I am right now, I'm going to show you. This is a real-time example. Okay, if this is a distribution here, so this would be a step one. Now, step two would be rotation around this level, and then it would start over again. And it's not always a nice, neat, coloring book diagram. Sometimes it's messy. Okay, here's a step one, and then you had this dip down here, then you came back up here, and then you had this Gaussian shape form. But it's there. So when I'm looking at a market, I'm not right now, and here's an excellent example. I sold this market today. I sold it in the room. Whoops. And why did I sell it? And I typed this into the room at the time that I did it. We had formed a balance area. And we had sold off down in here. Now, in this time frame, and I know this from experience, this is a mature structure, and it was going to break. I chose to assume, or I chose not to assume, but I chose to fade this area. So I was a seller. I sold once before it broke because my initial idea was to sell it at 99, and then when it went to 99, there was too much momentum, and I ended up selling it in here, and then I got stopped out. But when I took this trade, I was trading this auction process. I wanted to, my idea was, okay, and I took this trade based on, the reason I faded the market was because of the breadth thing and the volume thing and something else that I'm going to show you in just a minute, too. I was looking for more rotation than we had seen, but I got stopped out. Now, if my risk of this trade was from about here to here, the potential for this trade was from here to here at a minimum. So this was a market condition trade, and it was based entirely on auction concepts. It was based entirely on market condition. My stop was based on market condition, and my target was based on market condition. So I was willing to risk this to potentially make this. It didn't work. I lost money. But that's the diagram of an auction market trade, and you know, using this PB concept. Now, this was a structure that was mature, ready to break out, and I faded the upper extreme of the range. It got stopped out because it broke to the upside. This was the beginning of an initiative move. Okay, now this is a quote from Stottlemyre, and this was in 2005, and in a magazine interview, and he was asked the question, what would you say to traders who are using market profile as a visual display on different charting platforms and are studying your original theories? Stottlemyre, it won't be very helpful. But guys, good news, bad news. Everybody else is doing it. You know, that's neutral news to me. The good news for you is you will not be.